Howdy, Jacob here. Today we're looking at the company Belden. It is in the electronic equipment, instruments, and components industry. 3.8 billion market cap on 4.5 billion enterprise value. It looks like they design, manufacture, and market a portfolio of signal transmission solutions for mission critical applications globally. Founded in 1902. Whoa, been around for quite a while. Good for them. So growth, as probably expected from a company that's been around for over a century. You're not looking at an immense amount of growth. Pretty volatile revenue, to be honest. I thought it'd be a bit more flat, maybe more between maybe -2 and 5%, but we're seeing as low as 11% year over year and as high as 31%. There might be some acquisitions. This might just be offsetting some of the COVID hits, but the margin side a bit more consistent. High 30% on the growth side, low 10%, 11, 12% on the operating margin side. Return on invested capital is a bit higher recently, double digits. That's awesome. That's very likely above the weighted average cost of capital, meaning that they're increasing and creating business. But historically, it's been more along the lines of mid single digits. And bit dividends, 20 cents, pretty consistent, no increases, and is really nothing in comparison to what they make. So they can definitely afford it. 597 million cash on hand, zero short-term debt, 1.2 billion long-term debt. So they do have a bit of debt here. You're looking at 600 plus million net debt, and free cash flow production. Again, it must be a strange reporting, but this is likely this line right here is likely their capital expenditures line. And the CapEx is going up quite a bit. So we can see that they are making some acquisitions, making some reinvestments. That's making their capital expenditures go up. And their cash from operations is also going up. So that's positive. Not as fast as what I would think, but like production of cash flow over here, about 150, 190. And then more recently, it's about 180, 200. So free cash flow production hasn't increased that much, but the use of cash, pretty heavy on acquisitions, a little bit of reinvestment, good amount of share repurchases. That dividend of 8 million pays out less than 10% of their 5-year average free cash flow. So we'll probably stick with that dividend. No need to change that. The last 10 years, they haven't changed it. So let's keep that the same. Otherwise, revenue growth, I don't know if we'll be seeing incredible growth. I'll probably stick with maybe 3%, 13. So we're saying growth is relatively in line with inflation. Maybe demand doesn't really grow that much, but their prices grow. And then the terminal PE of 13 is slightly below market average. That's just to be a little bit conservative, and maybe at the end of 7 years, we don't even think that the growth is really in line with inflation. And then 5%, 7% as the margins here. Seems to be pretty sensible to me. Maybe I'll bump up the earnings margin since there's 2 years of zero. So maybe let's do 7. Let's just do 7-8% share change minus 3%. That would be 1% is 38 million. 39 million, so let's say 40. 3% would be about 120 million. Offset stock-based compensation about 140. That would be a hefty amount of their free cash flow. 140 million in relation to 5-year average is probably 70% or so. And it seems maybe a little high. Let's do 2%. That'd be about 100. That payout would be closer to 50%. I feel more comfortable with that. So let me bump this up to 4% because that's inclusive of acquisitions. So we're saying a little bit of money going towards acquisitions, about 50 to 60% to share purchases, barely anything to dividend, and then reinvesting in acquisitions to get these types of margins in return. And we're saying it needs to fall 66% before you get the return I'm looking for here. So right now, just a little bit out of my price range, but interesting company. Just I want to get the right price. Thank you and have a great day.